Hey everyone, if you're here, I bet you're as interested as I am in figuring out the stock market, right? Trying to find those perfect times to buy low and then turn around and sell high.
It really is like the dream, isn't it?
Yeah, it's like the holy grail of investing. And speaking of dreams, have you seen this market cycle prediction chart going around lately?
I think I've seen something like that, yeah.
It's called Periods When to Make Money. And it claims to tell you the exact years that you should be buying and selling stocks.
Wow.
It's been getting a ton of attention, especially with the stock market doing as well as it has this year.
I can see why people would be interested in that.
Totally. But before we all go out and rearrange our portfolios based on this one chart, we figured it was time for a deep dive to see if these predictions actually hold up.
Absolutely, we need to put it to the test.
Exactly. So this chart is supposedly based on the work of George Tritch,
Okay.
or maybe Samuel Benner.
Oh,
Yeah, there's some debate about who actually created it.
interested. A little bit of a mystery?
Yeah. Right. But anyway, the chart itself is pretty simple. It breaks down market cycles into three distinct periods: years of panic, years of good times, and years of hard times. Pretty straightforward labels, right?
Yeah, I can see how that would be appealing.
Totally. During panic years, you're supposed to sell everything. During the good times, you sell, sell, sell. And then during the hard times, you buy, buy, buy.
So simple. Too good to be true, maybe.
That's what we're here to find out. The article we're looking at today analyzes how the S&P 500 actually performed during each of those periods.
Okay, smart.
Yeah, let's see if the reality matches up with the predictions.
Love it.
So let's start with the dream scenario. Going from hard times to good times, buying low and selling high. According to the article, over 81% of those cycles actually showed positive returns.
That's not bad.
Not bad at all. And the average gain was over 32%.
Wow. But I'm guessing it's not always that straightforward.
You got it. That average includes a really wide range of outcomes. Some cycles saw gains of over 100%, which is incredible.
That's me.
I know. But others, like during the Great Depression, saw losses of over 40%.
Oof, yeah, that's a big difference.
Huge. So it's not as simple as just buying during any hard times and assuming you'll make a profit.
Right, it's not a guaranteed win.
Nope. And speaking of the Great Depression, that actually brings up another interesting point.
Oh.
So the chart's prediction to sell in 1927 would have helped you avoid the initial crash in 29.
That's good.
Right. But it wouldn't have protected you from the bear market that followed for years after.
So even if you timed it perfectly according to the chart, you still could have lost money.
Exactly. It just goes to show that those panic years can sometimes extend beyond just one calendar year.
Yeah, it's more complex than just looking at 1 year at a time.
Okay, so maybe going from hard times to good times isn't a foolproof plan.
Yeah, the data definitely shows that.
What about going from hard times to panic? The article found that those cycles were actually even more profitable.
Really. Even better than buying low and selling high.
It seems that way. Over 87% positive returns and an average gain over 61%.
Wow, that's impressive.
Right. But we need to be careful about getting too excited. There were a lot fewer of those cycles, and they tended to last much longer, sometimes decades.
That makes sense. Longer time frames can smooth out the volatility and lead to higher average returns.
Exactly. It's not necessarily that those periods were inherently better for buying. It's just the longer time horizon skews the numbers a bit.
Gotcha.
Okay, so we've looked at hard times to good times and hard times to panic. What about the transitions where the chart says you should be sitting on the sidelines completely, going from panic to hard times?
But let's see what the data says about that.
This is where things get really interesting and potentially problematic. Only 37.5% of those periods ended up with positive returns.
Oh, that's a big drop.
Yeah, and the average gain was just 17%.
Ouch. So you're basically just hoping to break even during those times.
Pretty much. And remember those booming periods we were talking about? Well, following the chart's advice would have meant missing out on some of the biggest periods of growth in the market.
Like when?
Like the incredible growth between 1945 and 1951.
Wow. Okay.
And more recently, the gains from 2019 to 2023.
Missing out on those gains would have been tough.
You're telling me this whole thing really highlights the debate about time in the market versus timing the market.
One of the biggest debates in investing, for sure.
Right. The article actually took this head on and back-tested 3 different investment strategies based on Tritch's chart.
Okay, that's smart. So they're basically seeing how well the chart's predictions would have worked in real life.
Exactly. The first strategy was just what the chart says: buy at the start of hard times and sell at the start of good times.
Simple enough.
The second strategy was buying during long cycles and selling during short cycles, but no short selling allowed.
Okay, I'm following.
And the third strategy built upon that by adding short positions during those panic to hard times periods.
Interesting. So 3 different ways of using the chart's predictions.
Yep. So which one do you think performed the best?
Well, based on what we've seen so far, I'm going to guess it wasn't any of the ones based on the chart.
Ding, ding, ding. We have a winner. It was actually good old-fashioned buy and hold that took the crown. Just staying invested in the market the entire time.
Wow, really? So even with all of those dips and crashes, just staying invested beat out every other strategy.
It absolutely crushed them.
By how much?
We're not talking small differences here. If you had started with $100 back in 1904 and simply held on to a diversified portfolio of stocks, you'd be sitting on over $62,000 today. But the best performing Tritch strategy, just over $5,400.
Wow. That's more than 10 times the return.
It's wild, right? It really makes you think.
So much for trying to time the market.
But why such a massive difference? Those Tritch strategies seemed pretty clever.
They did, but here's the thing. While they might have helped limit losses during certain downturns, the cost of being OUT of the market during those periods of growth was just too high. Even with some bumps along the way, the market tends to go up over the long run. Missing out on even a few of those big uptrends can really hurt your returns.
That makes a lot of sense. You're basically trading potential losses for missed opportunities.
Exactly. It's a classic trade-off. And in this case, it seems like staying invested even through the tough times pays off in the end.
This is making me rethink my whole approach to investing. Maybe I should be a little less worried about those short-term drops and focus more on the long game.
That's a common reaction. It's easy to get caught up in the day-to-day ups and downs of the market, but it's important to remember that investing is a marathon, not a sprint.
I like that analogy.
So we've learned that this chart might not be the magic bullet it claims to be, and that good old-fashioned buy and hold has its merits.
Yeah, that's definitely one big takeaway.
But what about those other strategies you mentioned, the ones that aren't about trying to predict specific years?
Ah, yes. Those are all about managing risk and maximizing returns over time.
Exactly. And that's what we'll be diving into next.
Can't wait.
Stay tuned.
Welcome back, everybody. So we spent the last episode unpacking this whole market cycle prediction chart.
Tritch's chart, yeah.
Right, and I don't know about you, but it really got me thinking about the psychology of investing.
Oh, absolutely. There's so
Yeah.
much emotion involved.
Right. Like we talked about how appealing it is to think there's a simple way to predict the market.
Yeah, it's like this desire for certainty.
Totally. Like if we could just figure out the pattern, then we could make a ton of money without all the stress.
It's very tempting, isn't it, to think there's some kind of cheat code.
Yeah, a cheat code for Wall Street. But as we saw, the market just doesn't work that way.
It's definitely more complicated than that.
Way more complicated. And the data we went over last time really drives that point home. Trying to pinpoint specific years to buy or sell based on some historical pattern, which just doesn't seem very reliable.
Yeah, it seems like it's trying to oversimplify a very complex system.
Exactly. And this is where the whole buy and hold strategy comes in.
Right, the idea of just staying invested over the long term.
Yeah, exactly. It acknowledges that there will be ups and downs, that the market is going to be unpredictable, especially in the short term.
But that over time, the market tends to trend upwards.
Right. So you're basically riding that wave. There will be dips and surges, but if you stay on your board, you'll eventually reach the shore.
I love that analogy.
Mm.
And speaking of patience, it makes me think about the emotional side of investing.
Oh, yeah.
Like I remember feeling that urge to sell everything during the last big downturn.
I think everyone has felt that at some point.
Right, I was watching my portfolio shrink every day and I was like,
Whoa.
oh no, I need to get out now.
I've totally been there.
But I took a deep breath, reminded myself of my long-term goals, and thankfully stayed the course.
That's the hardest part, isn't it? Resisting that urge to react emotionally.
It really is. It's so tempting to try to outsmart the market to time those peaks and valleys perfectly.
Yeah, but as we saw, even a seemingly clever strategy based on historical patterns can end up underperforming compared to just staying put.
Exactly. The data shows us that trying to time the market often backfires.
So if relying on these simple market timing models isn't the answer, what are some more effective ways to approach investing, especially in a market as volatile as this one?
That's the million-dollar question, isn't it?
It is. We can't just throw our hands up and say, well, investing is just a guessing game, so I'm not going to play.
Right. Luckily, there are several strategies that investors can use that are much more effective than trying to time the market.
Okay, tell me more.
So one of the most fundamental strategies is diversification.
I've definitely heard that term thrown around.
Yeah, it's super important. Instead of putting all your eggs in one basket, you spread your investments across different asset classes, sectors, and even geographic regions.
So if one area of the market crashes, your whole portfolio isn't wiped out.
Exactly. It helps cushion the blow of those market fluctuations and can lead to more stable returns over time.
It's all about spreading that risk.
Right. Another powerful strategy is dollar cost averaging.
Okay, I'm not as familiar with that one.
So instead of trying to time the market and invest a large sum all at once, you invest a fixed amount of money at regular intervals.
Okay, so like every month or every paycheck.
Exactly. And you do this regardless of what the market is doing. So whether the market is up or down, you're consistently investing the same amount.
That's interesting.
The idea is that by investing consistently over time, you're averaging out your purchase price. You'll buy more shares when prices are low and fewer shares when prices are high, which can help reduce the impact of volatility.
So you're not trying to guess when to buy or sell, you're just sticking to a consistent plan.
Exactly. It takes the emotion out of the equation and helps you stay disciplined.
I really like that. It seems like a much more manageable approach.
It is. And it's just one of many strategies that can help you navigate the market.
So it sounds like there's no one right answer when it comes to investing.
Right. Your individual goals, your risk tolerance, even your age, all play a role in determining the best strategy for you.
So what works for one person might not work for someone else.
Exactly. And that's where working with a financial advisor can be really helpful.
Okay, yeah, that makes sense.
They can help you develop a personalized plan that takes all of those factors into account and guides you toward the best path for your specific situation.
We've covered so much ground today. From market timing to buy and hold to diversification and dollar cost averaging.
It's a lot,
Yeah,
but it's all important. And I think the key takeaway is that investing doesn't have to be about predicting the unpredictable.
right. It's about making informed decisions, building a solid strategy, and staying the course.
Well said. Now, before we move on, I want to circle back to the concept of time in the market.
Yeah.
We've touched on it, but I think it would be helpful to look at some real-world examples to really illustrate its power.
I'm all for that. Let's see how this time in the market thing actually plays out in the
Does
numbers.
it do it?
Okay, so we've talked about all these different approaches to investing, and I'm ready to see this time in the market concept in action. What does that actually look like?
Well, one of the best examples is the S&P 500.
Okay, yeah, that makes sense.
Imagine we're looking at a graph of the S&P 500's performance, let's say since 1950. What do you think you'd see?
I'm picturing a line going up and down a lot, kind of like a roller coaster with some big drops for those crashes we've been talking about.
You got it. There would definitely be some major swings, like the bear market in the 1970s, the dot-com bubble bursting in the early 2000s,
Yeah, those were rough.
and of course the 2008 financial crisis. Definitely not fun times to be an investor.
I bet. I can only imagine the panic people must have felt. It would be so tempting to just pull all your money out and hide it under the mattress.
I think a lot of people did exactly that. But here's the thing. Despite all of those scary drops, the overall trend of the S&P 500 has been consistently upwards.
So even though it felt like the world was ending at times, if you just stayed invested, you would have come out ahead.
Exactly. Those investors who rode out the storm, they're the ones who reap the rewards.
It's kind of counterintuitive, isn't it? Like when things are going bad, your instinct is to get out. But history shows us that's often the worst thing you can do.
It goes against our natural instincts, for sure.
Yeah.
But the data is clear on this time in the market is more important than timing the market.
So those who panicked and sold during the dips, they missed out on the recovery that followed.
Exactly. They essentially locked in their losses and missed out on the gains that came later.
That's got to be a tough pill to swallow.
It is. But it's a valuable lesson. Short-term market movements are just noise. The real magic happens when you zoom out and look at the long-term picture.
Okay, so I'm starting to understand the importance of taking that long-term view. But why does this happen? Why does the market tend to go up over time, even with all the ups and downs?
Well, at its core, it reflects the growth and innovation of the global economy. Over time, businesses develop new technologies, expand into new markets, and find ways to become more efficient. All of this contributes to increased profits, which ultimately drives stock prices higher.
So even though there will always be periods of uncertainty and volatility, the underlying engine of economic progress keeps pushing the market forward.
Exactly. And that's why staying invested, even when it feels scary, can be so powerful. It allows you to participate in that long-term growth story.
This has been such an eye-opening conversation. We've talked about the pitfalls of trying to time the market, the power of buy and hold, and the importance of taking a long-term perspective.
And we've learned that investing doesn't have to be about finding some secret formula or predicting the future. It's about understanding your goals, managing risk, and being patient.
Well said. So as we wrap up this deep dive, what's the one key takeaway you want our listeners to remember?
Don't get caught up trying to time the market. Focus on building a solid, diversified investment strategy, and remember that time in the market is often your greatest ally.
Great advice. And with that, we'll wrap up this episode of The Deep Dive. Thanks for joining us.